Right. Hello, everyone, and welcome back to today's class. Hope the training is going great for you so far, and I hope you are staying on track. All right, today's class we will be continuing on to chapter 6. Oh, sorry, chapter 5 of life insurance, and we will be looking at the topic riders and supplementary benefits. All right. Now, additional benefits upon death, riders that provides additional benefits upon death. All right, I want you guys to see riders like, you have a pizza, you have a base, and then you have your toppings. Okay, now the life insurance itself, as we've looked at from chapter 1, chapter 2, chapter 3, chapter 4, is considered the base. Now, I want you to see those like the term insurance whole life and universal life. I want you to see those as your base pizza, yeah, like your main pizza. And then these riders are the toppings. Is it pepperoni? Is it cheese? Those typical kind of vegetables, right? So that's the way you want to see it. The toppings on its own cannot stand. So the toppings don't stand on its own as an order. You need to have pizza to have the toppings on it. Make sense? All right. So with that, principle or understanding at the back of your mind, let's continue with today's class. Now, the following riders increases the death benefit. Example, paid up addiction rider, term insurance riders, accidental death riders, and guaranteed insurability riders. So these four riders increases death benefit. And we're going to look into them one by one, what they all stands for. Okay. Now let's look at paid up rider. You see, PUA or paid up rider, paid up additional rider were introduced in chapter 2. Remember when we were discussing whole life insurance, right? That when you got your dividend, one of the options of receiving your dividend is you can use it to pay up addition. How does that work? That's what we're talking about here, right? Paid up addition rider was introduced in chapter 2 in regards to participating whole life insurance and its dividend options. You remember now, right? Now, the paid up addition rider gives the policyholder the ability to pay an additional lump sum premium to purchase a small paid up permanent life insurance policy. In return, he received the death benefit provided by the paid up addition and an increased cash surrender value. It can be purchased by whole life or universal life policyholder. Paid up addition rider is underwritten at the same time as the base policy, so no additional evidence of insurability is required. The paid up addition themselves are restricted. So there are some restrictions to this. Okay, so now what are the restrictions to these paid up additions? And if you watched chapter 2 video, you shouldn't have problem understanding paid up addition right there. Okay. Now the restrictions are to a specified minimum purchase at any time. Yes, the restriction that only a specified minimum that can purchase at any time. All right. You cannot say, okay, because you have $1 million, you want to buy a policy and paid it up with $1 million. No. There is a restriction to a specific amount that can be, paid up and added to the existing policy. Now, purchase at any one time. For example, the minimum purchase paid up rider that could be bought might be $500. That is if for a restriction of purchase at any one time. Okay, the minimum or maximum could apply. Now, to a specified maximum in any year. Now, for example, maximum of 2 could be bought in any year. All right. Now, to policy lifetime maximum, for example, the total number of paid up addition over the life of the policy that could be bought. It could be 10. So once you've exhausted these 10 options, then you won't have any other options to exercise. All right. To a purchase date, for example, purchase can be made on policy anniversary. To the maximum age of the life insured, for example, paid up addition could not be purchased when the life insured is older than 70. So these are some of the restrictions that are common and that we see in paid up addition rider. All right. There is never a requirement for policyholder who has a paid up addition added, who has added a paid up addition rider to his policy to buy a paid up there is never a requirement for the policyholder who has added a paid up addition rider to his policy to buy a paid up addition rider. But if he does not do so, he cannot carry forward unused paid up addition purchase right to future years. Okay. So what this is telling us is that if you have a paid up addition rider on your policy and in the contract states that you have the right to exercise it every year. Now, maybe during pandemic, you are not able to exercise it for some reasons in any particular year, you are not able to exercise your paid up addition rider this thing. You cannot carry it forward to the following year. That's what this is telling us. Why add the paid up addition rider? So you may ask, why? What's the point? Well, here's the reason. The policyholder is able to increase the death benefit and cash surrender value of his policy with each paid up addition. Such a rider is beneficial for individuals who expect that their insurance needs will increase over time, and the additional insurance is permanent. It will be paid on the death of the life insured. For example, Valerie is a business professional and she is the main income earner for her family. She expects her salary to increase at the rate of 5% per year. She has a 500,000 whole life insurance policy with a paid up addition rider. Under this rider, she is permitted to buy additional coverage of 10,000 per year for the next 20 years without providing her insurability. By making lump sum payments, she likes this option because she can increase her coverage as her salary increases. She is not required to purchase the additional coverage in any 1 year. But if she does not do so, she cannot carry that purchase forward. That is, she cannot purchase 20,000 of coverage in the following year. Okay. Now, moving on to term insurance riders. So we've understood what riders is, and we've understood what a paid up addition rider is. Now that we've understood the principle, we're going to look into these riders as it applies to the various types of life insurance that we have considered. Okay? Term insurance riders. A term rider adds additional insurance coverage to any insurance policy for a limited period of time. The death benefit of a policy with a term rider is the death benefit of the policy plus the death benefit of the rider during the specified period of time. There are 4 types of term insurance rider discussed below. Do we understand that? Now, a term insurance rider is a rider for that specified period of time. And the end of the term insurance will mark the end of the term insurance rider. So the term insurance rider cannot extend beyond the original policy, the term insurance itself. So we have 4 different types of term insurance rider. So we're going to be looking at them now. Each one increases the death benefit. Okay, we've looked at that. The death benefit of the rider may be the same as the base policy or larger. The life insured is the rider, the life insured in the rider may be the same life insured in the base policy or another person. Each life insured by the term rider is underwritten separately since each has its own risk of death. Okay? A term insurance rider cannot have a term that exceeds the term of the base policy, underlying policy in bracket, exactly what I just said. And once the base policy expires, so does the rider. If this is a concern, then the insurer should look for a rider with a conversion option. This option converts the rider to a standalone policy without the need to provide insurability. Okay, so now if you want to have your rider longer than the base policy, then it's beneficial to look into a rider that have conversion option. All right. Note that this is different from the conversion option on a term policy, which converts term insurance to permanent insurance. Very straightforward right there. Benefits of adding a term rider: efficiency. That is, it covers multiple lives with a single policy. It saves money for the policyholder since he is only charged one premium fee for the single policy instead of a premium fee for every policy he acquires. It's convenience. Adding a term rider that covers a life insured or lives insured other than the individual who is a life insured in the base policy is convenient for the policyholder since he only needs to keep track of premiums for a single policy. Awesome. There are several variations of term insurance riders as discussed in the subsequent pages. On a term policy, when a term rider is added to a term policy, the term of the rider cannot be larger than the term of the base policy. When the base policy expires, the rider expires. For example, both a 5-year term policy and its term rider terminates at the end of 5 years. Simply put, the primary reason for covering these additional people with a rider are convenience and cost. The policy fee is usually a fixed sum regardless of the amount of coverage provided or the addition of riders. On a permanent policy, the term rider added to a permanent policy can accommodate short-term needs, while the permanent policy, in other words, the base policy, provides a lifetime coverage. For example, the death benefit of a permanent policy might be needed for estate costs of a life insured, but his mortgage will be eliminated in 10 years. Therefore, the term rider will be for 10 years. Why add a term rider to a permanent policy? The premium for the permanent policy plus term rider will be lower than if the permanent policy death benefit cover the entire sum needed. For example, a permanent policy with a 200,000 face amount and a 200 term rider has a lower premium cost than a permanent policy with a 400,000 face amount. The policyholder only has to pay an administrative fee for one policy as opposed to having a number of individual policies, each charging an administration fee. For example, Zoltan is a business owner and he hopes to pass his business onto his children when he dies. But he expects that a tax liability of 500,000 will result at death. He also has a 200,000 mortgage with 10 years remaining that he would like to have paid off if he dies. The insurance needs with respect to the mortgage has a specific duration of 10 years that could be covered with term insurance. The insurance needs with respect to the business shares has no definite time limit. So permanent insurance might be appropriate. So therefore, Zocan could cover both needs by acquiring a 500,000 whole life insurance policy with a 10-year, 200,000 term insurance rider. This will be more cost effective than paying for a 700,000 whole life insurance policy. Family coverage rider. So we've seen that, right? So we've seen, let me take you guys back. We've seen riders on term policy, and we've also discussed the fact that the riders on term policy cannot exceed the term itself. Okay. Now, if you want the rider to exceed the term of the base policy, then you will have to seek the rider that have option for conversion into the main policy at the end of the term. And then we just finished discussing riders on a permanent policy. You see, this one is something that I use a lot. In fact, just depending on when you are watching this recording, just yesterday I had to build a plan for a family that now they have 25 years mortgage and they want that mortgage covered in event of anything. And they also want to have something permanent. So I built them three different options and scenarios. One that have the entire amount in permanent, and then the second one that have half and half in permanent, and then half a rider of term insurance layered on it, right? And also another layer of rider that we can add to. Anyways, we're going to see that shortly, will be critical illness rider as well. That is on one end. And then the third option I built was more of rider of temporary, like 200 permanent and 400 rider of insurance. So yes, these are the things that we do every day, but because you've not started your field training yet, if you're watching this, you may be wondering, okay, in your head, right? So now reach out to me immediately if you're in my team so that we can commence your field training. That way you can see how this play out in real time. And then you find out that it's not complicated at all, okay? All right, let's move on to family coverage rider. All right? Mhm. Family coverage rider provides life insurance for a spouse and children. It is available in units or and also available a higher unit value is provided for a spouse than children. Okay? Mhm. What this means is that it's available in units, and for spouse, you get to get more units than for children. Now, the number of units available for purchase is limited to a coverage amount sufficient to offset the funeral and burial cost upon the death of the spouse or child. Insurance for the spouse is based on his or her attained age at the time of the rider. Aha, okay. Insurance for the spouse is based on his or her attained age at the time the rider is issued and expire at a specific age, such as 65. All right. So now, anyways, we should have been familiar with this by now because even when you don't have to give evidence of insurability, that does not mean that your policy will be aged on your on your age at the time it was originally put in, the policy was originally put in place. No. What it simply means is that if you set up your policy 10 years ago when you were 30 years, right, and you are adding a rider, now that rider, if you are doing anything now, you're converting, like I've had my clients that have built permanent and temporal insurance riders for. And then after 1 year, after a couple of years review, by the time we are having our second year review last year, all of them seeing the performance in the permanent insurance, they converted everything to permanent. Now, converting to permanent 2 years later will be at their attained age. What does that mean? If they were 30 years when we set it up 2 years ago at the time, now the conversion of that temporary insurance rider to the permanent will be at their attained age of now 32. Get it? Good. Awesome. So that is what this is talking about, okay? Now, the rider automatically covers children when they reach 15 days of age after birth or are adopted. There's no limit on the number of children covered and no increase in premium as a result of the additional children added. Interesting. Coverage ends at a specified age, such as age 21. For example, Valerie's husband, Robert, is a stay-at-home father, taking care of their 2-year-old twins, Rebecca and Charlotte. Valerie is currently 7 months pregnant, but she intends to return to work 4 months after giving birth. Robert's role as a caregiver is essential to the financial health of the family, particularly until the children are in school full-time. So Valerie added a family coverage rider to her whole life policy for 100,000 of term coverage on Robert and 20,000 of coverage on each Rebecca and Charlotte. When their son is born in a few months, he will automatically be covered for 20,000 under the rider. And once he reaches 15 days old, and Valerie's premium will not increase. Interesting. Okay, there you have it. This one is called what? Family coverage rider. Okay. We've done family coverage rider under the permanent policy. So now on the permanent policy, this is the first coverage we are looking at, the family coverage rider. And this one gives the policy owner opportunity to add their spouse and their children, and then any subsequent children they give birth to, right, will be automatically covered the moment they turn 15 days of age. Awesome. All right, child coverage rider. All right, a child coverage rider excludes the spouse. Like coverage in the family coverage rider insurance begin when a child reaches 15 days of age and expire at a specified age, such as 21. There is a maximum coverage amount. Okay, that is a child coverage rider. All right. Now, converting child or family coverage rider. Why add either of these riders? Conversions allow coverage in a rider to be converted to a permanent standalone policy. For the spouse covered by a family coverage rider, coverage in the policy may be limited to a coverage of the rider. A child covered by either family coverage or child coverage, the child does not have a the child does not have to provide proof of insurability. Coverage provided by the permanent policy may be up to 5 times that of a rider. For example, the family coverage rider on Valerie's policy will cover each child until age 25, and it gives each child the right to convert the term coverage to a whole life policy with a face amount of up to 5 times the amount of coverage. Okay, or 100,000 without providing proof of insurability. Rebecca has a congenital heart defect that increases her risk of premature death. As long as Rebecca acts before the term insurance coverage expires at age 25, she can still obtain 100,000 of whole life coverage, even though she may otherwise be uninsured. Okay? That explanation is pretty much straightforward. All right, so we are moving on to accidental death rider. Okay, so we've looked at family rider, we looked at child rider, and we've looked at converting child and family riders. Okay, now we are looking at accidental death rider. An accidental death rider increases the death benefit when the death occurs as a result of an accident. So just bear in mind that accidental death rider only pays if the person dies by accident. If the person died by any other means, it will not pay. Yeah, that's the way it works. All right. Let's take a quick look here. An accident is an unexpected event that causes death. Death that occurs from a sudden illness is not considered an accident. Exactly. Death must occur within a specified period of time after the accident, such as 1 year. The rider is offered in units like the family coverage rider or as a multiple of the death benefit. 2 times the death benefit is the common amount of coverage. As a result, this rider is sometimes called the double indemnity. Yeah, this one, I see it's more common with maybe people that that drives a lot, maybe like truckers, people that drives by profession, taxi drivers, people that are more exposed, in driving may consider having this rider on their distance so that if anything happens, their beneficiary will get more. Okay. The rider has an age limitation, even though the base policy is not subject to the same limitation. Application may have to be made before a specified age, such as 55. The rider may terminate on a specified age, that is, the coverage may reduce at a specified age. An accident is considered to be an unexpected, violent, or traumatic event. Death resulting from suicide, self-injuries, war, or commission of a crime is typically excluded from the accidental death rider. And accidental death benefits are usually packaged with accidental dismemberment benefits and sold as an accidental death and dismemberment rider. Okay, for example, Janet had a 250,000 whole life insurance policy with a rider that doubles her death benefit for accidental death. She was found dead at the wheel of her car after it struck a concrete bridge. Her autopsy showed that she suffered a mild heart attack, which likely contributed to the accident, but that sorry guys, but that ultimately she dies as a result of injuries sustained in the crash. Jeanette's beneficiary will receive death benefit proceeds of 500,000. However, if the autopsy has shown that Jeanette had died instantly from a massive coronary event, her beneficiary will likely only receive the original 250,000 death benefit. So you see how tricky this could be, right? So this lady suffered heart attack, and because she was driving, she hit a concrete bridge, and then she died as a result of the accident. So now the beneficiary got paid um, the accidental death benefit. But the story would have been a different thing if, like, she was not driving, and then she suffered heart attack and died. Then there won't be any payment. All right. So this is what this is talking about. Gary? Awesome. Moving on to guaranteed insurability benefit rider. Yes, guaranteed insurability rider. I see this all the time, when we do universal life for children. All right, let's go into it. The guaranteed insurability rider provides an option to increase coverage in the future without having to provide insurability. It is very useful for those who currently do not have a large insurance needs or cannot afford a large amount of insurance, but expect they will want to increase their coverage in the future. It is available for both term and permanent policies. Premiums are based on the attained age of the life insured when the rider is exercised. So we've seen this multiple times, so we don't need to even overflog it. Just know that your premium, okay, is going to be based on your attained age, depending on when the rider is exercised, okay? Now, the rider has the following limitations. Number one, time. It must be used at a specified time, may be used only to a specified age, and may be used a specified number of times. So amount of increase. Each increase is limited. Total increase is limited. Limit is set as a percentage of face amount. Why add the guaranteed insurability rider? Why? A policyholder with this rider is guaranteed the right to increase coverage on the life insured, regardless of his health. For example, Doug recently got engaged and he and his fiancée, Norma, plan to have several children. Ooh. Doug is only 25 and his cash flow is tight, but he knows that he will need a fair amount of insurance protection once they start their family. He purchased a 10-year, 300,000 term policy now, along with guaranteed insurability rider that will allow him to increase his coverage by up to 20,000 each year. You see, so that is guaranteed insurability rider. So for that, you see, let's say every year that he exercises, right, his premium will be based on his attained age, and he will never be required to provide evidence of insurability ever. Okay, supplementary benefits. The following are supplementary benefits, also called living benefits. They are received while the life insured is still living and may or may not affect the death benefit paid upon death or the insured. Accelerated death benefit, accidental dismemberment benefit, waiver of premium for total disability benefit, and then parents/payer waiver benefit. So these are supplementary benefits. See, we've been discussing rather the topic itself. Is what we call riders and supplementary benefits. Now we are talking about supplementary benefits now. Okay. Now supplementary benefits is more or less like a living benefit. Okay. Is an add-on that you add to your policy that comes back to reward you even when you are alive. And these riders are accelerated death benefit rider. So it's not rider, sorry, accelerated death benefit, sorry, don't confuse it. It's not rider, it's benefit. Accidental dismemberment benefits, waiver of premium for total disability benefit, and parent/payer waiver benefits. So we're going to start looking into each of these one by one. Accelerated death benefit, what does this mean? Again, this is meant to reward you in life, not in death. Okay. Now, when accelerated death benefits are added to a life insurance policy, the insurance company will pay out a portion of the death benefit prior to death of the life insured if certain conditions are met. Accelerated death benefits are sometimes also referred to as living benefits. You see, this one we see it a lot with one of our partners called Beneva. You see, Beneva gives you what we call extreme disability benefit, whereby if you are not able to perform two major activities of life, you see, our partners Beneva will grant you access to half of your death benefit to the maximum of 250,000 and also to the maximum of your cash surrender value. You see? So this will give people opportunity maybe to do certain things that they would love to do, which they wouldn't have without the money. All right? All right, moving on. There are two types of accelerated death benefits. Number one is terminal illness benefits. And then number two is, let me see, we're going to get to it, but dread disease benefits. Okay. Now let's look at terminal illness benefits. A policyholder may receive a specified amount of policies that benefit in advance when the life insured is diagnosed with illness that will result in death. Is it terminal illness that is, the amount advanced is a percentage of the face amount to a dollar limit, okay? And death must be expected to occur within a certain period of time, just as 1 year, and the request must be supported by a qualified physician. So this one is a terminal illness benefit. So like somebody is given specific period of time to live, now there'll be advanced certain percentage of their death benefit to live on, to do. Maybe they have some places they would love to go on their bucket list before their final time on earth. Well, they are able to do so, right? Mm-hmm. The benefit is often automatically included in a policy or is sometimes extended on a compassionate ground. In such cases, it carries no extra premium. Yeah. So again, it's not automatic for the most part. Okay. Yeah, and that's why, like I mentioned earlier, one of our partners, and that's why I so much love our partners called Beneva. They give this complimentary. See, you don't have to pay for anything from it. It's complimentary. All right. Now, the terminal illness benefit is usually restricted to a maximum amount, a percentage of the original face amount that is up to 75% or a dollar amount. And the amount received by the policyholder is tax-free. Fantastic. Now, the death benefit is reduced by this amount or by the amount assessed by the policyholder, depending on how the advance has been structured by the insurance company. Yes, like for our partners, Beneva, is to the maximum of 250K. So even if you have 1 million, 2 million policy, you can only get maximum of 250,000. Okay. Now, the death benefit is reduced by the amount already paid in the benefit. Yes. So if you have $1 million and you take out 250 in the benefit, the beneficiary will only get 750 thereabouts. All right. The advance is treated as a loan. So the death benefit is reduced by the loan and interest charged on the loan. Now, the terminal illness, the benefit is payable to the policyholder regardless of the named beneficiary. If the beneficiary designation is irrevocable, then the policyholder will need to obtain authorization of the beneficiary, for example. Okay, so you see something major. A very vital principle have just been mentioned here. This word irrevocable, right, is very important. So if the beneficiary on this policy is irrevocable, even if it's a policyholder that is going to get this money, it can't without the permission of the beneficiary. Okay. Now, this is a typical example here for us. William has a 500,000 term life insurance policy on his own life with his wife, Elisa, named as revocable beneficiary. He bought a policy to help Elisa maintain the family standard of living if he dies prematurely, and the family no longer receive his employment income. The policy provides for a terminal illness benefit of up to 25,000 of the death benefit to a maximum of 100,000. Unfortunately, William was recently diagnosed with a terminal form of cancer, and he is no longer able to work. His oncologist had told him that he will likely die within 6 to 12 months. Elisa has reduced her work hours to help care for Williams and to spend more time with him. To help compensate for their loss of income, William applied for and received a non-taxable terminal illness benefit of 100,000. When he dies, Elisa will receive a death benefit of 400,000, which is the original face amount of 500,000 minus the terminal illness benefit of 100,000. Okay? All right, moving on to dread disease benefits. So, dread disease benefit is also known as critical illness benefit. I mentioned that earlier, didn't I? All right, so moving on to dread disease benefits, also known as critical illness benefit. Sip of black coffee. The dread disease benefit allows a policyholder to receive a benefit if the life insured is diagnosed with one of the conditions specified by the contract. The life insured does not have to be in danger of dying as a result of the condition, but the diagnosis must be supported by a qualified physician. The conditions covered will vary with the insurance company and contracts. Policyholders should be clear about which health conditions are covered and which are not. Although the number of covered conditions may be as high as 25 or even more, most policies covers the big four: heart attack, stroke, coronary bypass surgery, and life-threatening cancer. It is important that the policyholder reviews each policy carefully and understands what is covered in the policy. The life insured must live for a period of time following diagnosis, such as 30 days, for the benefits to be paid. It is paid as a tax-free lump sum because it is an acceleration of the death benefit. It is not taxable. For example, Scott has a 500,000 whole life insurance policy that includes a 100,000 dread disease benefit. He recently suffered a stroke that has left him almost fully paralyzed. Provided that he survives at least 30 days following the stroke, he can apply to receive a dread disease benefit of 100,000. The conditions covered under a dread disease benefit are similar to those covered under an individual critical illness insurance policy. For this reason, a dread disease benefit is sometimes called critical illness benefit. Why would you add dread disease benefit to a policy? This critical illness-like coverage may allow the policyholder to save money compared to buying a separate life and critical illness policy. That's right. If a life insurance policy uses the term critical illness benefit or critical illness rider, the policyholder should read the terms of coverage carefully. If the amount paid out when the insured suffers a covered condition reduces the death benefit, then the policy is offering an accelerated death benefit. If in the form of dread disease benefit. Now, if the amount paid out when the insured suffers a covered condition does not affect the death benefit, that is, it is paid in addition to the death benefit, then it's likely a critical illness rider for which an additional premium must be paid. That's so true. Okay. Yeah, I say this all the time. As a matter of fact, when I put a plan together for clients, I always love to include the CI option for them. If not enhanced, at least the basic ones. And I get them to see the difference in prices, usually not that much, right? Mhm. Now, accidental dismemberment benefits. So now this one has to do with um, loss of body parts that emanates from accidents, okay? The accidental dismemberment benefit is usually combined with accidental death rider. You see, to form the accidental death and dismemberment rider, this benefit requires, okay, so they're calling this riders, so it's not even wrong to call them riders after all. Now, this benefit requires an accident to occur. In this case, the accident must cause the loss of a body part or body function, okay? Which is accident that causes loss of body parts or body function. The schedule specifies what percentage of the death benefit is paid for specific losses. For example, loss of sight in one eye might pay 50% of the death benefit. Loss must occur within a certain period of time following the accident, such as 1 year. The maximum amount payable for any one-time accident or event is limited to 100% of the death benefits. So losses incurred via self-inflicted injuries, war, or the commission of a crime are generally excluded. You got it. All right. The following are the example of accidental death and dismemberment schedule of loss and the percentage of benefit paid. So now, if it's accidental loss that results into death, benefit will be paid 100%. Sorry, death is 100%, but both hands or both feet is 100%. Oh, entire sight of eyes is 100%. One hand and one foot, 100%. One hand and the entire sight of one eye, 100%. One foot and the entire sight of one eye, 100%. Speech and hearing both ears, 100%. One arm or, remember, or one leg is 75%. One hand or one foot, 66 to 3rd%. Entire sight of one eye, 66 to 3rd. Speech or hearing in both ears, 50%. Interesting. The thumb and index finger or of either hand, 33.1%. Hearing in one ear, 16 to 3rd%. Quadriplegia, which means complete paralysis of both upper and lower limbs, 100%. Paraplegia, complete paralysis of both lower limbs, is 100%. Hemiplegia, complete paralysis of upper and lower limbs on one side of the body, pays out 100%. The maximum payable for any one accident or event is limited to 100% of the death benefit. All right. Waiver of premium for total disability. So we are moving on to waiver of premium now for total disability. Now, this waiver stops the insurance company from charging premiums when the life insured is totally disabled. the policy and all the benefits under the policy will remain in force. Wow. Mm-hmm. What this is saying is that if you have this waiver of premium rider or benefits on your policy, and for some reason this you are not able to meet your obligation, depending on the criteria that is stated in the contract. So you will not have the waiver of premium policy will enable you to go on without having to worry about paying your premiums, and yet your coverage is active in force, right? So now the policy contract will define what constitutes the total disability, right? Like I mentioned. The definition of total disability can vary widely between insurers. While premiums are being waived, benefits continue to accrue under the policy. Thus, dividends will continue to be paid. If it is a participating policy, that's right, cash value may continue to grow and all riders and supplementary benefits remains in force. Okay? The waiting period. Now, the policy will specify the waiting period between the total disability, between when the total disability occurs and the start of the waiver. All right. Renewable or converted. All right. Okay. So, wait. Do you guys get this waiting period? You see, your contract, you see, when you are establishing waiver of premium on your policy, there's what we call a waiting period between when the total disability occurs and the time that the start of your disability. For example, it may say 30 days, it may say 60 days, it may say 90 days. So it depends on what is stipulated in the contract, okay? Now, renewable or convertible term policy. The waiver will continue if a term policy is renewed or converted. Okay. Now, parents or payor waiver benefit. So for parents or payor waiver benefit, the parents waiver benefit is used when the life insured is a child of the policyholder, right? Now, the payor waiver benefit is used when the life insured is anyone other than a child of the policyholder. Now, both benefits can waive premium if the policyholder is totally disabled or dies. Proof of insurability must be provided for the policyholder and life insured when a child is a life insured. Premium may be waived to a specified age such as 21. Okay, example is here, so I don't even need to go into that. So let's read the example together. Onwa is a primary income earner in his family. His wife, Anya, currently cares for their 3 children, who are all under ages of 5. He has a $1 million whole life insurance policy on his own life. He also has 300,000 term life insurance policy on Anya's life because he knows that he will have to hire someone to care for their children if she were to die. He is the policy holder. He has added a waiver of premium for a total disability benefit to the policy on his own life and the payor waiver benefit to the policy on Anya's life to ensure that both policies will remain in place if he becomes totally disabled. So this is this thing now, like very self-explanatory, okay? So now he took waiver of premium for the policy that you offer. Okay, let me give you guys an example now. So I have a policy, of course I do. And then we also have policies for our kids, right? Now, in event, this is to ensure that your policy or your children's policy does not lapse if anything happens to you, because children cannot pay the premium for themselves. You get it? So now what do? You can take a waiver of premium on your own in case your policy is not fully paid yet. And then you take a waiver of payer, waiver of policy on the one you have on your children, because you are the payer, you are the one paying. So if anything happens to you, both your own personal policy and the one for the kids are cruising in force. Okay? All right, using riders and supplementary benefits to customize coverage. That's very important. That is, okay, not important, that is very possible, right? Now, a policyholder can add riders and supplementary benefit to his base insurance policy to customize or enhance the coverage. This section explores some of the things a policyholder should consider when determining if these extras are appropriate for him. Okay, now, what are these riders and benefits? For example, like I said before, see, we can, in one plan, we can have universal life policy, term insurance policy, return on premiums rider, critical illness rider, all in one plan, right? But what this is asking us is you need to put into consideration what is valuable for you and what is not valuable for you, right? So now cost of coverage have to be put into consideration. Premium for the base policy will reflect additional cost for the addition of the riders and benefits layered on it, of course. Like, you see, it's just like when we go buy pizza, right? They'll tell you, okay, the pizza comes with cheese, right? But now you want extra cheese, you pay for it. You want pepperoni, you pay for it. You want vegetable toppings, you pay for it, right? Yeah. So that's the way it is. Okay, you got it? Awesome. Value of coverage. So again, you need to see the value of this coverage, that it makes sense. You understand? For example, when I built Universal Life for Children, I don't need to start adding critical illness rider. You know why? Because again, our Beneva, who is one of our partners, gives complementary critical illness to children to the maximum of 50,000. So why would I go and layer or add critical illness where there is a free one already built in the plan, right? So again, you need to know what value is this value worth this extra amount, right? The policy holder, and that is our job as the broker, as a licensed insurance agents and broker, to educate our clients, okay? The policy holder or beneficiaries must need the insurance acquired via the rider or benefit for it to add value to the base policy, just what I just explained, right? Riders and benefits are a way to structure coverage and reduce premiums in the base policy while maintaining the same total insurance coverage. Example, a permanent policy for 500,000 with a term rider of 500,000 provides 1 million in total coverage at a much lower cost than 1 million in permanent coverage. Very true. Limitations. Note the restrictions in many of the riders and what conditions or circumstances trigger payments of benefits, such as the many limitations applied to paid up additions. Purchases, exclusions. Sorry, I need to move. So we're looking at exclusion right now, okay? Now, certain events may exclude payment of the rider or benefits, such as a health condition not covered in the critical illness benefit. Exactly. If you take the base CI that covers heart attack, stroke, cancer, or coronary bypass, just for. So if the person suffers a different ailment out of that basic one that you've selected, it will not pay. See, the policyholder should also be aware of those conditions under which payments would not be made under a rider or supplementary benefits. Okay? Differences between companies. Riders and benefits offered very different, sorry, riders and benefits offered very differently by different insurance companies. So therefore, policyholders must not assume that the product provided by one insurance company will be the same when another insurance provider, offer them something, or with another insurance provider. The benefits may be better or worse. However, the death benefit provided by life insurance operates the same way across insurance companies. If the life insured dies, the death benefit is paid less any outstanding policy loan. For example, Elias decided to take company A's insurance policy because the waiting period imposes for the waiver of premium benefit is 3 months and not 6 months as imposed by some other insurance companies. In this example, Jackson would like to obtain the maximum death dreaded disease benefit possible. He compares company A and company B. He decided on company B because it provides dreaded disease benefit of 50% of the face amount as opposed to 25% provided by company A. For family history reasons, it is very important for Cindy to find a dreaded disease benefit that covers Alzheimer's. Company B does not, but she is happy to see that company A does. So it's important to look at all these things, right? Advantages and disadvantages of riders and supplementary benefits. The advantages and disadvantages of riders and supplementary benefits are summarized below. Advantages and disadvantages of riders. Disadvantage on this side and disadvantage on the other side. It can be used to customize coverage to meet policyholders' needs, of course. But the disadvantage is that there would be additional premium. Of course, you see, when you load your pizza with multiple toppings, you pay more. Some benefits may be cheaper when acquired via a rider supplementary benefit, and rather than applying them on a standalone policies, right? Now, there may be limitations and exclusions, right? And also coverage may expire when the base policy expires, depending on the benefits, separate underwriting on the life insured, and the policyholder may be required. That's right. And then the final advantage here is, okay, the final one is that it may give policyholder access to GIB, guarantee insurability benefit, and paid up addition riders while allowing him to pay for a lower amount coverage. And that brings us to the end of chapter 6. Yes, we did it. Awesome. So now we are going straight into the Q&A for chapter 6. I'm going to stop sharing my screen and then we'll do the question and answer. I would like, because my goal now is to have each chapter and the question and answer for that chapter in one class or in one recording. All right. So you ready? Ready? Awesome. This one, how many questions is this? Oh, just 15. Okay, that's not. All right, let's go. Which type of rider allows the policyholder of a whole life or a universal life insurance policy to pay additional lump sum premium to buy small amount of paid up permanent life insurance during the lifetime of the policy base or of the base policy? You know this, right? No, tell me you know it. Yes, you know it, right? So paid up addition, accidental death benefit, guarantee insurability, term insurance. You see, it's even in the question, it's insurance paid off to pay additional lump sum premium to buy small amount of paid up. So it's going to be paid up addition. Come on, you got it? Question number 2. All right. What does each rider or supplementary benefit have that is, in most cases, this result in additional premium for the policyholder? Time, cost, value, differences. What do each rider or supplementary benefits have that in most cases this result in an additional premium for the policyholder? This result in an additional supplementary benefit have that in most cases this result in an additional premium. I think cost, right? Differences. No, in an additional time. Cost. Wow. You see, this is one of those questions that when you see this one, I'm not even able to do any elimination method, like to eliminate the wrong tools and even deal with the right. And the reason I'm struggling with that is that I don't even know what this question is testing. Let's read it again. What do each rider or supplementary benefits have? Each rider or supplementary benefit have that in most cases, this results in an additional premium for the policyholder. Is it value, differences, time, cost? Which one do you choose? Put your answer in the comment section right now so that we can come back and check. For me, I'm going to go with my guts. And for that, I will say value. Say value. Question number 3. He said, which benefit is a lump sum amount that will be paid if the life insured loses a specific body part or body function as a result of an accident? Accidental dismemberment benefit, dread disease benefit, guaranteed insurability terminal. Is accidental disease benefit, accidental disease and dismemberment. Remember, the question is testing, either loss of body parts or loss of body function. Okay, guys? Okay. Question number 4. If certain conditions are met, which benefit is added to the life insurance policy that will pay out the portion of the death benefit prior to the death of the life insured? A, parent/payer waiver of premium benefit, no. Accidental dismemberment benefit, no. Waiver of premium benefit and disability, no. Accelerated death benefit, yes. They say if certain conditions are met, which benefit is added to the policy life insurance that pay out portions of the benefit prior to the death? You say it's accelerated death. Prior to the death payout, okay? Okay. Which benefits allows the insurance company to waive the premium if the life insured becomes totally disabled. Which benefits allows the insurance company to waive the premium if the life insured becomes totally disabled? Waiver of premium benefits, accidental dismemberment benefit, no guaranteed insurability, no. Terminal is waiver of premium. See, it's even in the question. Question number 6. Which benefit allows the policyholder to receive a benefit if the life insured is diagnosed with one of the conditions specified by the contract? Terminal illness benefit, guaranteed insurability, dread disease benefit, accidental death. Is dread disease, otherwise known as critical illness benefits, okay? It's not terminal illness, because this one says the policyholder to receive the benefit if the life insured is diagnosed with one of the conditions specified, one of the conditions. So it's not terminal. Terminal is when you're given specified amount of time to live. It's not guaranteed insurance. You see, again, when they are testing stuff like this, you need to know these 4 answers here are principles on their own. Okay, terminal illness is the one, like when somebody is diagnosed and given specific, maybe 2 months, 3 months, 6 months to live, that's terminal illness. It's not that. Guaranteed insurability is when you have a rider that ensures you can be insured for anything. You cannot never be denied. It's not that one. Dreaded disease, in other words, known as critical illness, is the answer, because the question asks us when one is diagnosed with one of the conditions. And it's not accidental dismemberment. Accidental dismemberment is when somebody sustains or loses body part or body function due to accident. Okay? Okay. Question 7. Which condition or which coverage is appropriate if the policyholder wants to obtain coverage for his children but does not have a spouse? Term coverage, permanent coverage, family coverage, child coverage. Which coverage is appropriate if the policyholder wants to obtain coverage for his children but does not have a spouse? I would say child coverage, because if you say family, they've already told us this person doesn't have a spouse, right? So let's see. Which type of rider adds additional coverage for death over and above that which is provided by the base policy for a limited period of time? Accelerated death rider, no. Paid up addition rider, maybe. Guaranteed insurability rider, and term insurance rider. I'm leaning towards term insurance rider, but again, let me read the question again. Which type of rider has additional coverage for death over and above that which was provided by the base policy for a limited period of time? For a limited, you see that this last sentence, for a limited period, that's what is making me to go for term insurance rider. Okay, because definitely it's not accidental death. Accidental death rider is when somebody dies by accident. It's not for limited. Paid up addition rider, that is when you use it to buy a paid up addition. It's fully paid up. Now, guaranteed insurability is not that much. So let's see. We are 6 questions away from finding out, right, guys? Okay. Which insurance All right. Which insurance policy rider gives the policyholder the option to buy additional life insurance coverage in the future without providing proof of insurability? Oh my God. You should know this, right? I know you know it. Come on, tell me. You know it, right? Do you know it? Of course, you know it. Guaranteed insurability rider. You see, with guaranteed insurability rider, the policyholder can add additional insurance coverage without having to provide insurability proof. Okay, it's not paid up by this insurance letter there. By now you know all this. You see the way these guys are testing these things, right? They're just testing these principles, different ways. But when you understand it, yes, there might be one or two here and there, including myself. You see, guys, see, I don't know everything. But again, you have the basics, the understanding of the principle. Yes, the exam is not, the pass mark is not 100%, it's 60%. So you still good, but just understand the principles, my darlings. Okay? Now, which waiver benefits if the life insured is the policyholder's child? Operate, operate much like the waiver of premium benefits. Oh, okay. So is it waiver of premium for total disability? No. Terminal illness, but no. Payer waiver, yeah, it's payer waiver benefit. So this one is testing. Say which waiver benefit if the life insured is the policyholder's child. You see, I used myself as an example when I was explaining this. Operates much like a waiver of premium benefits. Like, you see, waiver of premium for me when I take it as the policy, as on my own life insurance, but payer waiver of benefit when I'm taking it on the policy I have for my children. All right? Mm-hmm. Okay. Which is not an advantage of riders and supplementary benefit. Again, this one, every time they are testing, this wrong answer it can be confusing, right? So which one is not an advantage? Now let's see. Conversion to individual standalone coverage without proof of insurability may be possible for term insurance rider. Coverage expires when based. This, I believe this is right, true, right? But it's not only for term insurance, also for other permanent insurance as well. Okay, yes, because to stand alone, right? Yeah, for term insurance, this is accurate, this is correct, this is right. Now, remember, we're looking for the wrong answer. Coverage expires when base policy expires. Yes, this is right. Some benefits may be cheaper when acquired via a rider or supplementary benefit than when acquired as a standalone. Yes, this is correct. Can be used to customize coverage to meet policyholders' unique needs. Yeah, everything is correct now. Everything is correct. What do we do? Okay, let's look for the most correct. Can be used. You see, the question is which is not an advantage of riders and supplementary benefit. Let's start from the bottom. Can be used to customize coverage to meet policyholders' unique needs. Yes, we can use it to customize coverage to meet policyholders' unique needs. That's right. Some benefits may be cheaper when acquired via a rider or supplementary benefit than when acquired as a standalone. You say may be cheaper. No, benefits are cheaper now, right? You say benefits may be cheaper. No, typically they are cheaper when acquired via riders and supplementary benefit. So this may here is what is making me lean towards this. Coverage expires when the base policy expires. Yes. Yes. Conversion to individual standalone coverage without proof of insurability may be possible for term insurance right there. So, anyways, guys, we'll find out. But let's go with this. Again, you see the exercise, the way we do this, right? So again, you try to be using elimination method as well, okay? Because sometimes the answer may not come to you, but when you go through elimination process like this, you may get it, right? Now, what does a rider or supplementary benefit provide to the policyholder when they get the protection needed at a reasonable cost? We were asked this before. This question is being repeated. Value, differences, time, cost. What do they provide? Oh my God. Cost, time, differences. I think they provide differences, right? What does a rider or supplementary benefit provide to a policyholder when they get protection needed at a reasonable cost? At a reasonable cost. This question looks the same as the other one, but again, there's some differences right there. What does a rider or supplementary benefit provide to the policyholder when they get protection needed at a reasonable cost? It offers them, is it cost or time? Value. The first question, I choose value, right? I'm going to select differences. That is, they get different kinds of coverages, right? But we'll see, guys. We'll see. We're moving on to question number 13. How do riders affect the death benefit offered by the base policy? Does it decrease it? Does it expand it? Does it multiply it? They don't affect death benefit. How do riders affect the death benefit offered by the base policy? Decrease it, expand it, multiply it. They don't affect the death benefits. I think I'm leaning towards expand. You see, riders and benefits, it doesn't decrease. It decreases if it were to be, oh my God, that is, if it were to be terminal disease something, right? And you exercise it, it will decrease the death benefit. Multiply it, well, it will multiply it if it is accidental death and dismemberment. They don't affect death benefits. But they do. Now that's what I'm going to conservative space to be right now. I will go with expand it. Expand upon. Okay. 14. Which coverage is a common addition for policyholder who have a spouse and children? Family coverage, permanent term service, family coverage. Okay. Question 15. What can a policyholder do for the riders and supplementary benefits to his base insurance policy to customize or enhance the coverage? Subtract, no. Add, multiply, decline. What can a policyholder do for the riders and supplementary benefits to his base insurance policy to customize or enhance the coverage. Is to add now, right? Is to add. If you subtract, it's not enhancing it. If you multiply, you multiply, decline. No. Let's see. I want to finish at 10. And we'll check through to be sure that answered everything which we have. And we're gonna submit and fill. Oh my God, we missed a whole 4. So it means we scored, let's see, finished. We did this in 21 minutes, 11, which is 73%. And they always encourage one to score. So 80%. So now that you've watched the training and you've seen this question, it's the same question they're going to repeat for you. So you go and do your own questions now. I'm sure you're going to blast 100%. But let's read it and then look at this, the rationale, okay? Question 1, we got it. It's paid up addition. Now, again, if you want to read through it again, because I have read it, so if you want to read through it again, by all means, please, please, please pause it and read. Now, look at the rationale right here. Okay. Question 2, we didn't get this one. So I'm curious to see. They say, what do each rider or supplementary benefits have that is most cases this result in an additional premium? What is the answer? Cost. Oh, really? Oh, each rider or supplementary benefit has a cost associated with it, and in most cases, this results in an additional premium for the policy. Okay, question 3, we got that. If you want to read it again, please pause it and read it again. Okay, guys. Again, this is the rationale. Always read the rationale, okay? This one, we got it, yes. The answer is accelerated death benefit. Again, read the rationale. Waiver of premium, read the rationale. We got this one, yay. Dread disease or TI, okay. Okay. We got this one too. Child coverage, exactly. Well, this is a case of the guy that is not married, right. Yeah, and then read the rationale, please. Okay? Even if we read it before, you reading the question again on your own, you see, it's deliberate. I'm not reading it because I want you to pause the video, read it yourself again this time around, and then you see that the repetition of some of these questions and then the repetition of the explanation of the rationale is going to make the understanding of the principle more clearer to you, okay? Awesome. Wow. We got this one, guaranteed insurability benefit. Yes. Oh, we didn't get this one. Let's read it. Which waiver of premium? Which waiver benefit if the life insured is it's not payer. Parent waiver benefit, really? Wow. See? Says the parent waiver benefit if the life insured is the policyholder's child, or payer waiver benefit if the life insured is something. So okay, if the life insured is a child, then it's parents waiver benefit. But if the life insured is somebody else or his spouse, then it's payer waiver benefit. Okay, that's what their rationale is saying. You see? Wow, this is interesting. Okay, conversion to individual standalone. This one. Yeah, guys, remember this. We struggle, say, which is not an advantage of. You see, like, I noticed that when they are asking for the wrong answer, it's tough, guys. So please pay attention to it. You see, which is not an advantage of riders and supplementary benefits. And the answer is, ah, ah. Oh, yes. Oh, my God. Joy. That is not an advantage because the moment the base policy expire, the rider expires. So it does. Oh, yes, this is it. Ah, guys. Anyways, read the rationale. You see, again, this one, the answer will also value. Hey, ah, did you guys see what is happening here? This same question was asking similar question in question number 2. I chose value. My answer was wrong. And now this one, I chose I said the answer is value. So now read this question and go back and read. In fact, if possible, write this question down and the answers under it. On the other side, write question 1 down and look at the difference very well so that you point out why the answer to the first one is cost and the answer to this one is value. You got it? Good. In question 30, we get that one. It can be expanded upon. Yeah. Okay. And question 14, family coverage, we got that one. And question 15, we got that one. You add the rider. There you go. All right, there you have it. We've successfully completed chapter 6 and question and answer for chapter 6. And if you have seen value in the efforts that I have put into this so far, why not subscribe and leave a comment in the comment section. Thank you very much. And I'm going to see you in chapter 7 in the next class. Until then, have a good one and bye for now.